Hello, everyone, and welcome to our December RBA and Economic Update. I'm here with Evan, Lucas.
Same room today.
Same room today. There is a lot to cover off today, and we're mixing it up a little bit today. We're going to basically talk about Australia first. And so we've sort of given ourselves a little bit of headroom before the 2:30 announcement from the board and the governor. And we're going to sort of talk about that. And I think we want to touch on that GDP story.
Yeah.
We're going to take a stronger look at productivity. That's the killer.
So without being the Grinch, I think that's why we want to talk about this, because
That's true.
There is the reason we're going this way. We do need to run through. There has been a lot of discussion about the negativity of the GDP figures, why they could be a trigger to actually make them go today. Let's put our hands up. We are 15 minutes away. It's not going to happen, but it's more about we get a lot of data from them today, statement of monetary policy as well, about next year, because we do need to run through those GDP figures. We really need to have a deep dive, because we will then, once we go through the RBA and what the governor's put in the statement, we will go back to our normal output. We want to really talk about Trump as well.
Oh, Trump's definitely going to get a fair bit of our time, because there's a lot to talk about.
The other thing to remember, from today, the next meeting for us is until mid-February. So this is the last time you'll see Ben and I together till then in terms of doing these updates. But between that period, there is two Fed meetings, Trump's inauguration, 2 ECB meetings. So we do want to spend a bit of time after the meeting going through that. So should we jump in?
So we've got about sort of 13 minutes before we get to our announcement of the RBA. So what I wanted to do is talk to the Australian market first, as we were just saying. So inside the Australian market, I think we can paint a good picture around sort of what's been happening around GDP. So we saw the Australian economy expanded by 0.8 of 1% year on year in the third quarter. And that was easing from a 1.1% over the previous period. And that's coming in less than expected of a 1.1% expansion. So then when we look at that on quarter by quarter basis, what we saw is the economy only expanded by 0.3 of 1% in September. So they weren't good numbers, were they?
No. And so that's why we really wanted to have a good deep dive into it. So this is the real GDP figures you can see on here. Ben on the left-hand side's got the quarter on quarter, which is also the grey sort of Manhattan towers you can see on the other chart, along with the real year-on-year numbers. Now that's coming in at 0.84 of 1%. It's been reported in the media as 0.8. Whichever way you cut it, the only reason we are there is because of public spending. And we will talk around that side heavily in a minute. But it is also because private investment and consumption contributed actually nothing year on year to GDP in terms of growth. So there is numbers in there, don't get me wrong, but we understand in terms of growth, the household and the private sector are more than anemic, and they're being completely soaked over by government spending.
They are. And in essence, that's a problem long term.
Yep.
Right. We do not want the government being our investor. We do not want the government being the one, because obviously that's spending money that we don't have.
Well, we're not running recycling, right? Exactly. It's just debt on top of debt.
We do not have the surplus to actually be able to spend this. We're actually talking about expanding out that deficit. So that is a real problem for us.
And just the next chart to bring up then is what and where we sit. Because the other question also comes is, okay, 0.8, what does that actually mean to the rest of the world in the equivalent? And this is a comparison against our major economic peers. And you can see that they are the ones that we should be comparing ourselves against, not anything else. And New Zealand's a bit different. That one there is actually, we get their data next week. So that's Q2. Just be aware. That's why there's a little asterisk next to it.
Yep.
But either way, that's not a good place to be where we find ourselves. And I would say you need to be looking at Canada, the UK. I don't normally like using the US because they are different, but Canada and the UK absolutely is who we should be comparing ourselves to. And we are behind those two significantly. We are not the same as Austria, Japan, Finland in terms of what they are. So
we've got the land mass.
Yeah.
We've got the natural resources.
Yep.
We've got the talent pool.
Yes.
What's going on?
Talent pools, that's a great question.
We have too much regulation. We have a few other things that are red tape in terms of how we do it. But look, I mean, you were saying before we went to air, this is the worst set of numbers in.
So let's have a look at that. So this here is what you also keep hearing about, which is per capita GDP, which is like for like, if you want to use that term, or household GDP, whatever term you want to use. This is comparing taking out migration and all of those changes that happen with bringing additional resources into the country. This is what is going on. And since records began at the ABS, this has never happened. 7 consecutive quarters, 8 out of the last 9. And all things being equal, that one that's missing, which is the Q4, that will also show that it will be 2 full calendar years of the household going backwards.
So it clearly shows a couple of things. We do need, now, one of the things, we've got an aging population, right? So the demographic that we're seeing, this retiring demographic, so many people are turning at 65, getting access to cash. We need this younger pool of immigration to come in. We need this new generation of workforce to come in. And usually they're positive for overall GDP. That's why we're seeing the 0.8% rise. But on a per capita basis, something's going wrong. We are not proficient. We are not producing activity to the level that we need to.
Because that needs to be pointed out. You need to understand that migration is why this country works.
Yes.
Migration is also the reason why we get fresh capital. So despite all the political angles about, trying to slow migration down and the issues around housing, which Ben will talk to you about at the end of this presentation, we need it. Right, we are a migrant country. We use the Seeker song all the way through in terms of how we look at that. So that needs to be put out there that this, and we are and need to remain an import nation of people. That is what we do. But it's the next things that we need to look at.
But so what does it mean? I mean, it ultimately says to me that are we providing too much middle class welfare and incentive? Like, I think about that. I think about, okay, so I know we talked about, in terms of childcare and all, that's a good thing because it puts people in the workforce. Those types of things are really important. But I'm sitting back and I'm saying how the government fixes our problems is they throw money, populist politics we call it. We're going to talk more about that later. But it's this money that they throw into cost of living. And they just basically, it's almost like we're taking a pill, but it's not curing us. It's just prolonging this pain management. So it's pain management, but really what we need to do is fix the problem.
It's almost, instead of using pain management, we're using anaesthetist
and
just anesthetizing our entire pain to the whole concept. Because again, I always talk about this when I do talks. Is if you're, I think it's about 53, I've worked it out. At 53 in the 91-92 recession,
that's
you would have been 18.
So
you would have just left school. You would have been into the workforce.
Correct. You
would have experienced some of it, but because you were that young, the impact was probably negligible on your longer term outlook on things. Okay, I'm 18 years old. I might have lost my job. Nah, I'm going to go and do other things. Come back a couple of years later, 22, 3, and away you go.
But I didn't have that safety net.
But you didn't care at that age.
No, but even then, I mean, but the mindset was that if I needed money, I needed to go and find that opportunity.
Correct.
Like it's not now where, okay, now the government's got to solve my problems.
No.
Like in terms of they need to give me more of this and they need to do more for...
Well, it's not even that. It's more the government thinks they need to do that.
Well, they do because the polls show them that...
That's the problem.
That's the problem. So once, this is the famous line from Charlie Munger when he says, once the populace works out how to vote themselves the money, then you have a stagnant economic story. You don't have a vibrant domestic economy. All of those things start to, that capitalist, that investment creates jobs. All of those things are real. Let's look at this last chart in terms of this, because this brings it home. We've got, a few minutes to go before we switch over to the RBA announcement. But what are we seeing here in terms of real GDP, jobs, and working hours?
Yeah, so this is taking together our little banter session that we just had and putting it into chart form, because we do have jobs, right? We do have migration and people are getting employed. The thing is, as you can see, and this is a little bit abstract, I understand that, but this is showing the total jobs growth. That's what it means. So from 2019, which is, neutral, we then saw COVID, jobs were lost. Now we're seeing a job expansion, just to give you an example of why that 100 point is there. So we've seen a 13.5% increase in job creation. Which is fantastic. Normally you'd be championing that like tomorrow. And you can see jobs filled, which is additional jobs on top. It's also expanding. But the hours worked is all over the shot. It is not at the same level. So what that also means is that people have jobs, but they don't have enough work or want more work. It also means that the actual hours they're working productively is lower. So instead of working a 7.8 standard day, 8 to 5, they might be only working 6. So their productivity is lower. So the GDP figure, which is that solid figure, shows you very clearly that the output created through, even with the jobs creations we've had, is below. And so the final chart to go to now is, again, showing the decline in productivity from the output of labor. So we have great labor supply and hours worked, but the productivity per hour is negative. So it means that we are losing all of that. And it's hard to describe without going abstract. But again, it means that your household wealth is going backwards because the amount of output that you're doing is actually less than it used to be. Even though you're working the same amount, the amount of goods and services you're producing is negative.
Correct. But the other component of that is that I'm choosing to not actually, in the 30 hours that I work, I'm getting enough money so I don't want to work anymore either. Like, there's a choice that people are making as part of the gig economy and that flexibility of work. So again,
that's cultural, isn't it? Too?
Yes.
This new thing of like, hang on a minute, I want the gig. I want the flexible working hours. Yeah. I want
pay me a huge amount of money, but I don't necessarily need to produce that much.
As much as I used to. And so this is the dilemma government faces. Yeah. This is the dilemma that you and I as business owners and what have you face as well, is that we know we have a changing workforce, but we have this problem. We have this problem right now, which is that we've got people working, but they're working less hours, more unproductive. And I know you guys hate that. I know that term sounds awful, and it's true because, hang on, how am I less productive?
It's clear in construction. I mean, it's correct. Absolutely
much more measurable product, right?
Yeah, correct. And, we produce so much, but we don't. Obviously we've got more work people in that workforce, but they're not producing as much. I mean, it's almost like it's been dormant in terms of the productivity in construction. Now, part of that's regulations, part of that's, negotiations in terms of work hours and work condition. All of those things add up to how often I can grab the tools and how often I can work and all the delays. So we have lots of problems when it comes to how we set up for work and then obviously how we get about doing that work. Because if you keep asking me to do that, then ultimately, you keep giving me more for nothing. Yeah. I'm going to be happy with that.
And we're about to hear that. So we are 30 seconds away or thereabouts from now going on to that. And we're bringing it up here, as you can see on the live screen. But that's what the RBA, in their boffin language, say to us.
They're trying to be polite.
Well, I think they're trying to be what they all are, which is that they are trying to be market neutral, right? So they're trying to use language like lawyers do, which is, as long as we don't use language that distorts,
politically influences or whatever that particular looks like.
You look at it from that perspective, that's why it is what it is. And, you there come through, so unchanged as expected.
Yeah.
And they're talking about this heavily. Like, the first opening line here from what this is, underlying inflation remains too high. That will be, when it comes up in a minute, the big change that we're going to see from November to December. They are now having to say in the first paragraph, just so you know, we still have an inflation problem. Because as Ben said at the start of this, the thing that we keep hearing is government feeding us an arbitrary scenario. They have arbitrarily made inflation low at 2.1%. If you go through that inflation figure, the reason that we were there is because we saw a 12.3% drop in energy. Shock horror, that's when the WA government, Western Australian government, and the feds all gave us money in our pocket.
Yeah.
And so they are telling us that inflation is still well and truly above. Unmeasured or underlying inflation are at 3.5%, which is still some way from the 2.5%, so the midpoint of the band. And the most recent forecast from the November Statement of Monetary Policy does not see inflation returning to sustainably midpoint targets until 2026. So I'm going to say this again live on air. I'm very close to feeling that.
You're almost getting the 50, the pineapple from me.
I think you're so close to saying, February is done, because that there to me says that not only has nothing changed, they have once again come out and put their foot down and said, stop thinking that we are close.
Stop spending, stop thinking.
Stop doing what you're doing. Get on with basically dealing with the fact that at the moment, choice is being crimped. Ben and I have been talking about this for the last 13 episodes that we've done of this program.
Yeah.
And it sucks to sit here and say it. And as I said to you, I'm going to sound like a Grinch. And I know I'm going to sound like a Grinch when I sit here and talk about this. But as Ben's bringing up the difference changes between November and December, it shows you very clearly that they are now basically constantly having to reinforce inflation psychology. If you keep spending, inflation will not get back to target until a year and a half from now. That is exactly what that first paragraph says to you. And that's the concern.
But you've got to read between the lines too. What Evan told us also about GDP there was this story that 0 from business, 0 from households, all of that GDP growth, the 0.8 that we were talking about before and the 0.3 for the quarter, that came from government. So if anyone's arguing that the government's not actually influencing where interest rates are, that's wrong.
Yeah.
So they've got this delicate piece, haven't they, in terms of...
So we've got cat and mouse right now.
Correct. We have. I mean, they're trying to keep... Well, you know, if I'm Labor, I want to basically say I'm running a good economy. The economy is still growing, you know, because I don't want to take a recession into an election. And I'm saying, you know, the money that we've got, we're giving handouts for households, and that's propping up the economy. But what they really needed to do was stop the give, take their medicine, and we would have had rate cuts by now.
So the flip side is, at the moment, if you look at the Liberal Party, they're deliberately not costing anything.
Correct.
Because we are within 6 months. In fact, it's probably actually slightly under that now. The expectation out of Canberra is that we'll go in April.
Yep.
Of an election. So the cat and mouse is also, the RBA is fully aware that we're about to have an election. And they are fully aware that government spending obviously is now ramped up to the record level of output we've ever seen.
Yep.
Both sides of government are going to promise some serious Christmas presents. That's what's going to happen.
I know, and you've got the state governments who are also, I mean, the state governments aren't helping the federal government in terms of the additional infrastructure spending that they do. We're moving to this whole idea of populist politics. And it's a problem.
Yeah, and our state is perfectly example.
You want your problems fixed, we'll throw money at it. You want your problems fixed, we'll throw money at it.
And the advantage for them is that they can show it to you. So in this state, looking at Victoria, infrastructure spending, until 3 years ago looked fantastic. You could walk literally down your street, you could see the fact that your level crossing was changed, that there was infrastructure being built at every single corner that you were looking at, except it's now become inefficient.
And it's cost $44 billion more than they said it was going to cost.
And that's still not the end of it.
And it's not the end of it. And they've taken all the construction jobs away from resi construction. And so we've got this balloon out. So you can see here, they've changed some of the wording here to sort of talk about.
Interesting that they've removed highly from this today, considering that we're going to talk about Trump and the highly uncertain nature that he's about to bring into the world. And again, you look at what's going on inside this change between. So just to let you know, November is in black. The red is the new wording from the December meeting. So if they've scratched something out, that's gone from the November statement into the new one. It's all pretty the same. It's just more direct. It's even more direct in terms of how they're saying it to you, which is we cannot see underlying inflation getting back into target until 2026. That overall things are still tracking in the same way. The central projection is household gross consumption will be pretty anemic. You can see that in everything they're talking about with regards to where they say it. And then there's high level.
Some upside risk here. Inflation appears to have eased, and we'll see that in the sentiment. There's been a bounce in sentiment, at least that interest rates aren't going to keep going higher. So that seems to be the case. What have they said in the final statement in terms of?
Basically unchanged. And that was the other part they had from last month, is that then core. So even though they've got 3 mandates, right? They have 3 mandates, which is the full prosperity of the Australian people, the full employment of the Australian population, and price stability of the Australian dollar. That's inflation. That last one realistically remains number one priority of those 3 mandates.
So here we go. Recent data on inflation and economic conditions are still consistent with these forecasts. And the board is, where it says not ruling in, not ruling out, is gaining some confidence that inflation is moving substantially towards target. Now, that is a little bit of movement.
It's a little bit of change
in terms of looking at that particular story. So I'm obviously, at 3 o'clock, we'll get the governors.
And you're hoping there is some ruling.
There might be a little bit of hope there for me.
In February.
Might be a little bit of hope.
All right. I'm dashing that straight out. Look, as we expected, there is no movement. We will now wait till 3 p.m. to hear what the governor has to say. So let's move on to the other story.
Conditions are softening, but that's exactly what we want to look at. Okay, so that's what we got in terms of the RBA update. Let's move on to looking at how they came up with that decision around the inflation data. So we can see here that inflation in Australia, annual inflation rate dropped to 2.8% in Q3 off the back of those energy things from 3.8% in Q2.
Government likes to tell you about the November one, which is at 2.1, but let's put that to the side.
Exactly. Now, this was the lowest reading in Q1 since 2021, with good inflation sharply slowing. Well, again, it was purchased to slow on the back of those energy and electricity incentives, the energy relief bill, the rebates around that. In terms of service inflation, here's a problem, stayed elevated, 4.6 versus 4.5. Notably, prices eased for alcohol, tobacco, 6.7 versus 6.8, so not very much. Clothing, 1.7% from 2.9. That's a good movement. Housing, 2.8 from 5.2. That is a good movement.
That's a huge movement.
That's a huge movement, which we've got to be happy about. Health, 4.8% from 5.7%. So that's still too high.
Pretty
Inflationary services still not budging in terms of 6.2 versus 6.4. In addition, transport costs fell for the first time since Q4 of 2020, and it was in disinflationary territory at negative 0.9 versus 4.6. So thank you, Qantas, for reducing some of your exorbitant prices on your airfares. In contrast, inflation was steady for food at 3.3, whilst cost accelerated in recreation, 2.1 versus 0.9, but not still within the band. Education, problematic here, 6.4 versus 5.6. This is off the back of those international students not coming, and the university's basically saying, well,
we're going broke.
We're going to have to find the money somewhere.
Yep.
So we're racking up the prices. Thanks very much, government. And housing services was also 0.7 versus negative 1.1. Now, the big one that we need to be focusing on in terms of core inflation and the sustainable, trend in inflation was the core mean, which is our trim mean, which was 3.5% year on year. Now, that's the softest gain in nearly 3 years, aligning with consensus, but still exceeding the bank's 2 to 3% target range. So we still look to be, challenged when it comes to where inflation currently sits. Let's now jump into the consumer sentiment. We didn't have the unemployment data. That's not released until this Thursday. So we've got to have to keep a really close eye on that. That's going to be really important, because if unemployment remains low, i.e. employment remains strong, that's also problematic in terms of being able to adjust the current cash rate. Now let's have a look. The Westpac Melbourne Institute Consumer Sentiment Index in Australia rose 5.3% to 94.6 points in November, improving for the second straight month and hitting the highest level in 2.5 years, as the outlook for the economy and finances finally turned a little bit more optimistic.
Just a touch.
Just a touch. Key components in the index also showed strong improvements were family finances compared to a year ago. That surged by 6.8%, whilst expectations for the next 12 months grew at 4.4%. Now, the economic outlook for the coming year jumped 8.7%, and the confidence in the 5-year economic outlook also rose to rose by 6.5%. Now, really important, we're still in pessimistic territory in most of these indicators. That's important to note. But the gains were assessed by the economists at Westpac as being part of the relief that no further rate hikes.
Yeah.
Not so much that there's a rate cut coming, although most of us, including me being in particular, thought that we would see a rate cut at the end of this year, but it hasn't materialised. It hasn't materialised.
Yeah. And so at the start of the year, I remember sitting here, by this time I was expecting 2.
Yeah.
So the fascinating thing that I point out with this one is particularly the family finances versus a year ago.
Yep.
So it shows how tight and how pessimistic we are around their finances now, despite, as you just pointed out, probably the family finances are feeling the least amount of pressure they have in the last probably 20 months.
Job security. That's it. Employment.
No more rate rises. The rate rises have been absorbed. You've also seen a falling of inflation. I mean, that all puts into it, yet the feel, and that's what this is. That's what all surveys are with regards to consumer confidence. They are surveys.
Yep.
It makes sense that you feel you're worse off now than you are, because during that 12 months, you've absorbed all of those additional costs and you can't see out of them. But then you flip to the one below it, which shows you that the family finances in the next 12 months, we're actually optimistic.
Now, so that's interesting, isn't it? Because we've got job security at the moment, but here's what's coming over the hill. This is the telling story. What you heard Evan say earlier was around GDP,
Mhm.
and most of that was coming from government spending and not from business investment and businesses themselves. Let's learn what the NAB confidence index also said. And this is disturbing because what we saw was the confidence index plunged to a -3 reading from a near 2-year peak of 5 in the prior months, and it's falling below the long-term average. Meanwhile, business conditions sank to their lowest since 2020 at a reading of 2 versus 7 in October. Now, pressured by declines in sales, 8 versus 13, profitability, 5 versus -1, unemployment, 2 versus 3. Now, activity fell across all industries, with retail manufacturing reporting the worst conditions. Labour cost growth in quarterly terms was unchanged at 1.4%, while purchase cost growth slightly increased 1.1 versus 0.9. Measures of cost pressures were mostly steady through though retail prices slowed to a quarterly pace of 0.6 from a prior 1.1. Here is our problem. Businesses are finally saying enough is enough. All right. Unless you're getting government jobs and government contracts, you're hurting out there, and that's going to have to start showing up in jobs.
Yeah, and so the other part of that, the reason they're hurting and why they can't compete is that if you actually look at the wage price data that came out in November, that public sector jobs are now paying more in terms of the comparable work. Well, at least the wage expansion is bigger. And then what isn't taken into that data is that superannuation benefits are significantly better in the public service. So it's between 10.5 and 11 for private. It can be as high as 17% in the public service section. So the competition for labour is the other part of this argument, is that, yes, right now having support from the government with a sluggish economy is fine, but the sustainability is not. And then, as it's been pointed out, they are competing so well that they're now actually drowning private investment out because they can't compete with the service that's required.
It's look, we need to just have this reset moment. It doesn't need to be a hard landing, but the way we keep going at the moment, something's got to give, and we can't just keep throwing good money at bad when it comes to gum. Yeah,
right. And so then they'll jump ship again. If you're going to talk about moving the economy, one of the ways you could do that was to actually freeze public sector working wage growth. Now, the screen for that, I get that, would be horrendous, but they'll make the decision. Well, if I'm not going to get my wage increase in the public sector, I'm going to look at somewhere else where, and you're going to cause that shift.
It's important that we do cause that shift because they're probably a little bit sort of fat anyway in terms of the number of people we've got working in government sector. Let's also talk about this chart, because this chart around credit growth, remembering that obviously with the cash rate, the reason this is it's a blunt instrument. It's the only lever the RBA has got to work with in terms of releasing cash, in terms of monetary policy. And they normally need to do that. They pull it back to reduce credit growth, and they release it to obviously increase investment and stimulus, and that grows the economy. What's the problem with this chart, Evan?
The problem with this chart is that we're growing at 6.3% in credit to the end of October. So this isn't just to the end of September. This is the end of October, this data. And Ben will go through this in a minute. I mean, look at that middle part of the chart. Look at the investor housing increase that we've started to see. Look at the business investment. It's come down, but it's ticking up again. And if you look at the Manhattan Towers, the bar chart below, you can see the trend is also moving in that same direction. So the argument is also there is that if you were to make credit cheaper by an interest rate cut or several, the investment that brings isn't actually ringing true, because it's not spreading into GDP. It's not actually seeing business investment go up. And although, as I said, the business chart is interesting and it is slightly expanding, it's pretty anemic. The growth is coming in housing and those kinds of debt leverages. And that's what the RBA is also worried about, is that, again, blunt instrument. Does it stimulate one area more than the other? Yeah, we know in Australia that we will probably end up jumping back into property, rightly or wrongly. It's not the question. It means that, again, their instrument and their tool that they're well aware of is going to create distortions, and distortions in the wrong places. And so they are delicately balancing that problem, is that although it might be cheaper for businesses to borrow, they're not doing it. Who is doing it? The household. And they're going off and doing it in property. And that is good, but it also, from another argument, doesn't actually increase goods and services output?
Well, no, it depends on if you're buying an existing property versus investing into new.
Yeah,
which
we know we do.
Yep, and of course, when you buy new, it's obviously new production and so forth, and there's extra jobs. I mean, if I'm trying to land the narrow path, I'm sitting on the RBA board and I'm looking at that business one, I'm mildly happy because my narrow path that it's
pretty narrow in that chart.
That's pretty good for me, because one of the big things we don't want to see is we don't want to see that chart falling off a cliff, because that means we're in for a hard landing, right? If businesses aren't going to invest in new equipment, new productivity, more people, expansion, that means less jobs. That obviously has that cycle. So that's sitting where I want it. The housing investment in terms of, I think there is, and I'm trying to get it a little bit deeper in this data myself, the amount of noise I'm hearing around commercial, so people taking equity out of their home or using their home as collateral for a commercial piece of real estate. That is interesting, because that might be showing up in terms of...
That is fascinating.
Yeah, because that's a little interesting.
Because commercial real estate has been suffering post-COVID.
It has. But I mean, now that I've got record land taxes in some states and territories, I can actually get the tenant to pay even my taxes. Not here in Victoria if I've got a retail lease, but in other states and territory, there's still an opportunity around that. So we'll be watching credit policy and credit growth and housing approvals like a hawk early into the new year. But it definitely does feel like businesses, the momentum in business is really starting to slow, and we've got to basically get fiscal policy and monetary policy in line. But we're coming up to an election, like you said before, so they're going to start throwing money at all of us to win our vote, and that could be detrimental to where the cash rate sits by the end of 2025 off the back of inflation.
Yes, when you and I are sitting here having this discussion in 12 months' time, it's going to be a very interesting talking point.
Very interesting. Let's talk about the wrap on the quarterly results and the monthly results out of CoreLogic. Our good friends at CoreLogic have given us the hedonic index here, and we can see we're starting to see Sydney's run out of puff. Melbourne is a problem of sentiment and confidence on the back of higher taxes and higher debt more generally across Melbourne market. Brisbane still, living in its sort of afterglow in terms of attracting population growth. It's got really also strong rents there. So you're seeing both the investor and the owner-occupier playing in that market. Adelaide's similar. Adelaide's had a terrific run. We do expect that to start to peter out into 2025. Perth.
Can I?
Yes, you go.
As the property person that you are, how do you see for the first time ever, Adelaide's median price popping above Melbourne?
Yeah, so I think one of the things we've got to get context on, when you break that down into houses and units, or housing and other, the median house price in Melbourne is still somewhat higher.
Yeah.
So it obviously means that in terms of the concentration of apartments and so forth, there's such a small mix in those smaller cities, whereas Melbourne's got a reasonable apartment size market. So you break those two things out. But it's a really good question, because what it also demonstrates, because we're seeing a lot of interstate investment into Melbourne, and that is just simply off the back of I'm not putting too much thought into this, other than Melbourne looks cheap.
Yeah, and that's why I want to ask that question.
Yeah, because it's not a sophisticated judgment call. Let's just say that.
And the reason I want to look at that is that the pickup from the media on that was incredible.
Yeah.
And we need to actually start saying those kinds of things, to say, yeah, Melbourne looks cheap, but cheap in what areas?
Yeah. And I think
the question.
Yeah. Well, I still think that Melbourne's got long-term prospects are great, right? I mean, ultimately, it's a very livable city. It's going to have some short-term challenges around the economic management and, just how much sort of debt we get into and what sort of taxes and business investment. I mean, look, let me just give you a quick summary. We've got the highest unemployment rate here in Melbourne in every capital city. We've got the highest number of small businesses failing in Australia is in Victoria at the moment. And ultimately, we've got the lowest number of new investment and new businesses starting in Victoria. So what does that tell you in terms of the economic management that we've got of what is a very stale government, and a government that needs to be moved on in terms of, the offerings that they've got here for Victorians. Looking at Perth now, you can see another strong monthly result and another strong quarter, but still slowing, right? Ultimately, this cycle is running out. It needs, in terms of the absorption, it's still doing really strong absorption. So at some point in time, we're either going to creep to that interest rate cut, and then let's see what happens in terms of whether that delivers a bit of extra stimulus. But if the economic activity, that flywheel that I keep talking about, that water wheel, if that slows right down and it's not picking up water at the same pace, then even if rates go lower, it doesn't guarantee that property prices are going to move more generally. Darwin is the smoky. I've said it before. It's definitely showing, from an investment point of view, and certainly from a new government who is very pro-business, very pro-investment. They're doing a lot to try and get the property market moving up there. So that's one to watch as a speculative. I'm not guaranteeing that's going to go well, but that's certainly one I'm keeping an eye on. And then obviously the Canberra market. Again, it's not where we would go for investment. The amount of taxes that you pay, effectively you're collecting rent for government and just putting it straight into their coffers. So don't touch that market. So combined capital is up 0.1, combined regional is up 0.3, nationally only scratching out a 0.1 increase. So that gives you a bit of an idea. So let's talk about the key takeaways for the Australian market before we move on to the other big news, which is the Trump 2.0 story. So we can see at the moment, the RBA's hands are tied. They can't move on rates. Inflation is still too sticky. We know that easing is going to be less likely in February and more likely in May, as evident
post
the election. In terms of employment remains too strong. Look, if we get a really strong, a poor result in the December quarter, maybe there's a slimmer of hope for me, and maybe the governor and the new board might give the government in power a bit of options.
So you've got the last Wednesday in January.
Correct.
Is the day.
It's my last hope.
It's your last hope.
Okay. We've still got this massive problem around productivity. We've got to address that, and we still have this housing problem because we don't have the right policy settings to create that type of stimulus. All right, let's move now to the biggest economy in the world, the US. This really is the biggest news pretty much of the year. Let's be honest. Yeah. The leader of the free world is going to change. The direction of policy, the direction of lots of things is going to change. And so I want to know, Evan, where do we start on Trump 2.0?
Yeah. So I've deliberately put in these 4 things because they are the things that matter. He has a 20-point plan that he has put out there. Do also want to highlight this. There is a lot of discussion about him not doing what he said. It was just his rhetoric. I need to point out the whole man's principle is based on action. And if you look at what he did in 2016 through 20, he actually did 82% of what he said. So you'd have to back him to actually say one of the things that he is good on in terms of his word is delivering what he said he's going to do. So these are the 4 that matter, not just to the US, but to us, to the world.
It's important. I mean, he delivered something of those did he deliver it all? That's the question. I mean, the 60% tariff threats, is it going to be 60%? Is it going to settle at 40?
So the argument is he delivered that, and not only that, the Biden administration kept them and actually expanded them.
Yes.
So
correct.
You need to understand that, what he's now saying it's that 60% he originally put back in 2017 and more. But first and foremost, let me go through the economy. One of the things that I find fascinating that is going to be very hard, one of his slogans was to end inflation and make America affordable again. Political leaders don't have, even the leader of the free world, have that action to do that. So he hasn't actually stated how and what he would do to bring about ending inflation. He certainly talked about doing, expanding US energy, so the drill stuff, bringing US gas, US energy sources to market as fast as can to bring that price down. But if you actually have a look, since he started saying that, oil's down 21%. So the energy impact in inflation in the States has been a big reason why they are now back to 2%. So even if he was to ramp it up, you'd actually be seeing businesses probably making a loss in drilling that. So the economy is the interesting one. He said a lot, but not a huge amount of policy direction.
But looking at also some of the data around just how important cost of energy is in an advanced economy and being competitive on cost of energy, it's absolutely essential. So nuclear is very much back in the mix.
It is, but he hasn't really said that. So,
well, I mean, you're seeing, irrespective of whether he's going to produce that or whether it's going to be the big tech mobs, in terms of the likes of the Microsofts and so forth.
We'll get to France, but France is a different story. But they are the ones that are leading the way on.
And then obviously same with South Korea. In terms of what they're doing there. So if you can bring the cost of power down to net zero, like which is really where you will have economic prosperity. I mean, the fact that just manufacturing, it does, so your wages can move higher if your energy costs come down by 30 or 40%.
It's the couch of building it. Yeah. So that's the economic
it's the delay, and that's not going to happen in the 4 years.
Because that brings on to the next one, which is trade. And so this is a big one for us in that space. So what I want to show you with this chart here, this is the trade policy uncertainty index and where it currently sits. Just to point out, that's obviously significantly higher than when he was first elected, which you can see is the first of those three pikes. The second two are COVID cycles. That's how uncertain we are right now.
He's a disruptor.
And already we have seen him using trade as a weapon rather than actually anything else. So we are talking about 10 to 20% tariffs on almost all foreign goods, which will probably include Australian goods as well. We need to be very aware that I would be very worried in our agricultural products because we are much more competitive than the US.
Yes.
And we are net exports of agriculture. So we've just got back from getting the Chinese giving us tariffs, and it looks like our major, security partner is about to hit us between the eyes. So that's one. Then also what we've seen around China, you just discussed that, the additional material. China's very aware of that. We have been feeling that pressure. You can see that in the Australian dollar, for example.
Yes.
The fact that it's sitting at 65 cents, where realistically it probably would be about 68 to 70.
Yes.
Outside of that, again, that's an inflation problem for us. We're a net importer. Cost of business bringing into Australia is getting more expensive. We need more Aussie dollars to bring US dollars here. So that's the other part. Then you've seen it with regards to the threats. So the threat of 25% tariff on Mexico and Canada around their immigration policy. This is why trade is so uncertain and why it'll be so hard to deal with. Because then we get back to, let's talk about migration and the immigration policy he's brought. Why we are talking about that policy on this program is the impact on inflation. And let me work you through this very quickly. If you are deporting very cheap, very efficient, because that's what it is, labor that then has to be replenished with higher costing, less efficient labor, that is 101 inflationary tactics.
100%.
And so that, I think, is what's been lost on this whole discussion. The biggest issue I see economically is his immigration policy. And again, our agricultural products will become immediately more attractive to Americans because we are more efficient, and they will be cheaper because of this policy.
So migrant labor inside US forced out 15 million or 10 million.
However many he wants to
he wants to push out.
Let alone the cost of actually using the Defence Department to do it.
But then I'm whacking a tariff of between, say, 20 to 60% that I'm threatening. That is totally inflationary. Like, I'm still going to have to bring some of those goods into the country. Like, even at a 40% rate, with those Chinese electric cars, they still need to find a market. Now, they might be dumped down to Australia. We might have the cheapest car, sort of market in history.
Correct.
But everything about doing these types of things is inflationary.
And that's what we saw from 2016 to 20. I mean,
correct.
This is the argument, is that everybody goes, oh, look at what he did with regards to the stock market growth and whatever else. There's been multiple of reports, including from like actual people that back him. So, you saw investment banks, I'm not going to name them in the States, that were backers of him, that actually said the average American went backwards because the cost of their products were more expensive than if the policy had not been changed.
Correct. So is he going to, the 4 years, he's expecting that innovation and industry will be able to repurpose themselves and get up and running?
But is that what he's doing? Innovation and industry, that's a great point, because what he's trying to do, his argument to the people and why he's been voted in, is that he will bring back US manufacturing. He will bring back the car industry.
He'll bring back
There's a reason they've left.
That's right.
Because they're uncompetitive and they're not efficient.
But so you bring, so your only hope is bring your cost of energy, cost of production down, but wages have got to hold or go up. So you're going to have to then obviously repurpose your manufacturing, maybe robotics, maybe those types of things that come in. So less workers. But you're talking about tens of millions of workers that you've made a promise to
relocate back in.
And basically then what's
called re-prospecting. So bringing that manufacturing back
Yeah.
to the US. It means infrastructure build to bring up to spec those manufacturing hubs that were lost. So you look at a Detroit, you look at Pennsylvania,
correct.
You look at the Rust Belts.
Yep.
They can't just go back into those manufacturing centers and turn them on.
No.
Because the technology in them is 20, 30, 40, 50 years old.
Correct.
So this is why the immigration policy is the one that caught my attention the most from an economics point of view, not from a humanitarian point of view.
Yeah.
Because this is going to be the biggest problem with his current policy ideas, is that it is going to be
it's all inflationary.
Incredible.
So hence the tax cuts are going to obviously counterbalance, hopefully more in the pocket. So that's the sort of balancing act.
But it's where he's doing it.
Well, yeah. And look here, here's one thing I do like about his policy. I'm a big fan of Doge. I'm a big fan of the government of economic efficiency, because that's the red tape.
Despite the fact that it's also got a cryptocurrency linked to it.
Well, no, it hasn't got the cryptocurrency linked to it. But in terms of the idea of cutting spending, because they have a debt problem.
Yes.
They have a huge debt problem. I mean, we're talking about the global default currency here with a massive debt problem and their size of government. If they can get that government more efficient, then I think there's going to be some real results there. So they're going in for a couple of years till 2026. I'm a fan of Avakes in terms of him coming in. Obviously, Elon Musk, when he goes in and says he's going to do something, he normally does it. So I think I can see some really important reform around protections and all of this waste in terms of being able to, how long it takes. It takes 26 weeks to get an approval to build a home in LA. Like, that's nuts.
Yeah.
It's half a year.
That.
Like,
you are also
crazy.
talking about, though, the impact of it will be huge.
Oh, it will be amazing.
Yeah.
Like, it's going to be one to watch, because everyone's going to be watching over the fence and going, how's that going to go? So look, there's no doubt that what we are going to see is it's going to be unpredictable.
Mm-hmm.
There's going to be disorder. There's going to be the haves and the have-nots that come out of this. Now, he's promising that he's trying to make America great again for the middle-class America. That's his test. He's trying to get that middle-class America back, because that has been dissolving over the last 20 or so years. So he's got a massive job ahead of him. He's got an interesting crew of people in the White House to do it for him. So
all I would say is put your seatbelts on. And as we said at the start of this, the next time we talk to you, he will be in power, and some of those ideas will have been enacted.
Okay, so let's take a look at some of the data out of the US. We're not going to spend a huge amount of time on this. All we're interested in is interest rates.
Yeah.
Because the reason why the dollar is really high is they're thinking inflation is going to be high, and that means the interest rates are going to stay high, which is why the dollar is where it is. So the annual inflation rate in the US accelerated to 2.6% in October, up from 2.4% in September, which was the lowest rate rise since February of 2021. It was in line with market expectations, but it marks the first increase in inflation in 7 months, as energy costs declined less than natural gas rose by 2%, the same in the September result. Also, inflation for shelter steady at a reading of 4.9%. On the other hand, inflation slowed for food and transport, and prices continued to fall for new and used cars and trucks. On a monthly basis, CPI rose by 0.2, consistent with the previous 3 months, also matching forecasts. And finally, core inflation, that trim mean inflation, where we take out those more volatile items, remains steady at 3.3% as expected. And monthly core inflation is also holding at 0.3 of 1%, which was the same as September. So let's then have a look at the dot chart in terms of the plot, dot plot, and see what we learn about where we think rates are going to go, because they've got their meeting next week.
They do. So as I said, they're going to have 2 meetings before the next time we talk to you. The reason this chart matters is that what they told us in September, so they have had 1 meeting since then. They did cut rates by 0.25 of 1%.
Yep.
There's 1 more next week. So their forecast will not be missed, which is basically to bring the federal funds rate to between 5.25 and 5%.
Yep.
So that means they will cut next week. And as you can see, their expectation for 2025 is a further full 1% out of the federal funds rate. And that would bring it back to a range of 3.25 to 3.5% by this time next year. Now, that is, I think, optimistic considering everything we've gone through. And I will be watching this projection very closely, because the advantage of the dot plots and why the US is I would argue the way that they run their central bank is the gold standard.
Yep.
The communication is absolutely paramount. And
Yep.
it is every one of those blue dots is a member on the board. And you can work them out through their communication. So they don't have to tell you who they are, but you
Yep.
do know. And it gives you just such a better understanding about the evenness, the debate that's going on. So you can see that the outliers from both the hawkish and the dovish ones are there. So I will be watching year-end 2025 very, very closely because I expect particularly those 7-8 dots at the bottom to start moving up quite quickly.
I couldn't agree with you more. I think if we took a snapshot of this and we were talking in July of next year and we put them side by side,
well, I think
we will see that movement. Yeah, we'll do that.
We will do
I think
that.
we'll give it 6 months.
Yeah.
But then we'll start to see
Correct.
that real movement because, I can't see, you can't put a rabbit out of the hat. You can't try and attempt what they're trying to attempt without that being inflationary, unless you get an enormous amount of productivity into, and robotics and obviously AGI and agents and all these things that are coming, and energy efficiencies and that's also renewable energy. It's not just nuclear, but their energy mix is going to be a competitive advantage for them if they execute on that for themselves. So the key takeaways out of the US is that we really don't know what an America will look like under a Trump 2.0.
No.
It's going to be fascinating.
The market's telling us that too.
Yeah, exactly. Obviously, there's, the strong economy, or, will it be a stronger economy, or will we see inflation rule supreme? That will be told in the next sort of 12 months as that plays out. And what will happen to that global trade story and tariffs, and also a lot of other governments around the world will be watching around their reform agenda and obviously making those governments efficient and having smaller governments as opposed to having larger governments. All right. The other big news as we move on to the China story, I mean, China has got to be concerned, and they are. And, we don't have a lot of data to talk about for China, but what we will be talking about is, this particular story here, which is their interest rates. And news overnight was critically important. So let me just get to the news that happened. So the Chinese Politburo, which is a direct influence on the stance of the People's Bank of China, the PBOC, stated that it will embrace, here we go, moderately loose strategy for monetary policy in 2025 in the readout preceding the Central Economic Work Conference that they had.
Which is the rubber stamp conference.
Correct.
Let me point that out.
And the move marked an aggressive shift from the characteristics prudential, sort of a prudent approach or stance since 2011. Foreshadowing more fiscal stimulus, the government also pledged to support property and equity markets next year, magnifying their signals that the government will accelerate its counter-cyclical support to China's recent economic struggles and to maintain ambitious 5% GDP targets for the next year. The decision extends the CCP's growing efforts to stimulate the Chinese economy following muted reactions to previous policies, but the market also sees the statement as a countermeasure to potential tariffs of 60% out of the US following President-elect Trump's inauguration next month. Evan, what's China got to do?
So, as you've already said, this is going to be the biggest change in 14 years in terms of the output stance. The caveat is this, as they also themselves pointed out, there has been muted response to what's happened since basically Golden Week. So before Golden Week, there was a reaction to the stimulus package they put in. The 3 packages since has been really almost laughed at. It's been as low as a quarter of what was expected by the market. So they have now lost patience with what they're doing, clearly. Not only that, this goes really against Xi Jinping's major stance. So not just the changes to the policy for the PBOC for the past 14 years. It's the financial stability package that he brought in 2017 and 18 that he's going against with this change. So
he has to move. He's got no choice.
So to point out how much a reaction this statement had, because as I said, the difference between having the Publico do this versus we've seen the economics board come out and say what they'd said in the last 3 is that this is realistically the voice of the CCP. These are the guys that actually matter the rubber stamp policy, and as we pointed out, the Central Economic Working Conference, that's just the rubber stamp, what's been said. So this will happen, and that's why, for instance, when we're doing this on the 10th of December, the overnight reaction in the US was BHP and Rio, for example, jumped up 4.5%.
I was going to ask you, what's the impact to Australia?
The Australian dollar jumped 1.5% off the back of it, because the Australian dollar is seen as a... So this is now being believed. And why we went through Trump so heavily is that the impact on Australia, we know what it is. We saw it in 2016 through 20. We saw the impact of iron ore and bulk commodity exports into China. And we do need to be aware of that problem. This is a step positively for us, whether you like it or not, whether you agree with it or not, doesn't matter. That is what this is seen as. And that does need to be met with a little bit of excitement from the point of view that we can possibly see us being, inverted commas, lucky again, because our main trading partner is having to ratchet it up their efforts to get their economy going.
So property equities is all about wealth effect and that sentiment. That sentiment's really important for that domestic consumer. There are 1.3 billion people in China. They need them spending. And so this is off the back of that. Now, their one trump card has been inflation. So they are able to do this because they're not in any risk of having inflation in their domestic economy. So they pull this trump card out, they throw the stimulus in there, and they see where it lands, because they really have no other choice.
Correct. But their risk is, as somebody's starting to point out more and more, is that, are we seeing the new Japan of the 90s and the 2000s?
It makes logical sense. You've got an aging population. The demographic profile works exactly the same way.
The growth profile,
so the whole
thing.
The golden era of China, I think you're right there. And I mean, ultimately then that's the political stability story that might play itself out over the next 30 or 40 years in China.
And I think it's a really fascinating thing, is to say.
It is very fascinating.
Is China Japan 2.0?
Yeah. Good call. Okay, so let's look at the key takeaways. Obviously, that stimulus is a way of China's 2025 package around moving their domestic economy. The tariff story, Trump 2.0, we'll keep saying it. It's going to impact more global trade. We saw the G20 conference last month also focusing in on making sure that no one else if Trump's bluff or if Trump makes that call, everyone else tries to keep their heads, be sensible about what they're doing and not counterbalance or basically counteract in terms of also introducing tariffs. That becomes a tariff war. That's not good for global economic growth. So that's also interesting. Now, the positive, could it be a positive net for Australia? Well, certainly when China needs our iron ore, when China needs our raw materials, that's good news for us in terms of our overall economic activity. All right, let's finish off now. Bring it home with obviously the Eurozone in terms of what's happening in this particular market. And this one's the basket. It's the basket zone at the moment, that's for sure. So we want to talk about the annual inflation. So let me kick off the summary of the data out of the Eurozone. The annual inflation rate in the Euro area accelerated for a second month to a reading of 2.3% in November from a reading of 2% in October, matching market expectations of those preliminary estimates. This increase was largely expected due to the base effect, as last year's sharp declines in energy prices are no longer factored into annual rates. Prices of energy decreased 1.9% less than the 4.6% fall in October. Also, costs for non-energy industrial goods increased 0.7%, above 0.5% in October. On the other hand, inflation slowed for services, food, alcohol, and tobacco. We like that when we hear services. Looking at their core inflation, which excludes volatile food, energy, alcohol, and tobacco prices, as we say, remained at 2.7%. Remember, their target's 2%. The same as in the previous month, and defying forecasts that it would edge slightly higher to 2.8%. Finally, looking at the month-on-month results compared to the previous month, the CPI fell 0.3% following a 0.3% rise in October. Evan, this inflationary data, what does it say in terms of, we don't have their update on the interest rates because their meeting
next week,
ECB is next week on the 12th of December as well. So what do we make of this particular story?
Again, the reason the Eurozone is a zone is the catch of having so much collation in there. So periphery is part of the reason why we saw inflation up. France, another reason we saw inflation up. Because if you look at Germany, Germany's inflation was 0.3 of 1%. So the biggest economy in there, its inflation's fine. In fact, it's a little bit
Germany's
low.
doing
You
pretty
would you would argue it's low. It's too low.
Yep.
But you have this inflationary pressure from overspending in the periphery, which is the smaller countries.
Yep.
Then you've got France, and France is the real concern.
Yeah.
Not just geopolitically, we'll get to that in a minute, but you're talking about an unemployment rate of 7.3%. Compare that to Italy, which is normally seen as a bit of a problem child. 5.8%.
That's when you get sort of revolt from your citizens, right?
And we're seeing that.
Yeah. So and they're looking for a politician who's going to promise them the world back into populist politics. It's a dangerous area where we need to be. And I think the other thing for Germany is exports are big, right? So a tariff war is something they do not want to be a part of.
And they're coming. So let's quickly pick on that, because the Germans are fascinating. So there is an argument that we are possibly seeing the end of the German manufacturing high-end quality. I mean, they are still that. They've still got that global cultural
quality.
picture.
Yep.
But you look at Volkswagen, for the first time in 40 years, they've actually had to properly offlay service workforce and cut wages.
Well,
because they're
the products coming out of China.
Yeah, they can't keep up with them. And so
the hybrids and the electric vehicles.
They even begged the federal government in Germany not to react to China's tariffs on European car exports because they didn't want them to do it because they knew that Chinese would respond, and they have. Oh. So Volkswagen's, it's not the canary, it's the gorilla, because it's that massive.
Yep. Yeah,
it's the gorilla to say, are we watching possibly the end of the German supercycle manufacturer in the post Second World War era? You look at their high end quality. I mean, people still want German goods.
Mercedes.
But they're offlaying the mid and low stuff already overseas. So if you look at their brands, they're spread across quality now.
Yep.
I
think they've got to move with market. And at the end of the day, if you're going to get dumped in with cheap commodity goods from
China, but the EV vehicle world is the thing that they're going to suffer with, because then you've got now Trump also talking about EV vehicles and putting tariffs on those.
Well, combustion engines are out. Combustion engines are out in 2030.
Yeah, so ICE engines are done. And so, but you look at what he's bringing on.
Yeah.
He's bringing tariffs for not just China but also for Europe. So it's a fascinating scenario that they're facing right now.
And so no wonder with that sort of uncertainty that we saw the consumer confidence in Europe also drop. So we saw that drop by 1.2% to a reading of negative 13.7 in November, and that was worse than market expectations of a negative 12.4. In terms of, this was the lowest reading since June, with the index remaining below its long-term average. In the European Union, sentiment also fell by 1.1 points, reaching a 5-month low to a reading of negative 12.4, driven by significant declines in consumer assessment of both the overall economic situation and their household future financial outlook. If I don't have a job, I'm always going to be worried. Whilst their elevations of the household's past financial situation also weaken the decline in the margins. And finally, in some better news in the data set, consumer intentions to make major purchases showed some improvement, but off a low base. Let's now move into talking about the business confidence, and we still see a pretty poor story. I mean, look at that pattern.
Yeah,
pattern's going in the wrong direction. We saw business confidence in the euro area increase to negative 0.77 in November, which was up from negative 0.93 points in October. But it's still
the trend is there.
Trend is not in the right direction. I mean, that's trending the right, but the overall trend is not in the right direction.
You can draw a line of best fit, and you can see that it's not getting smaller. It's ramping up.
It's not where we need to be. So let's wrap up in terms of what we know about the euro area. It is a political story over there. Unfortunately, when you do have high unemployment and people feeling dissatisfied, the government's on the nose. Populist politics can play here. That's a real danger.
So, I mean, quickly, let's point out France. I mean, Michel Barnier is out purely for the fact that he put through a fairly balanced, fairly centralist policy.
You mean a sensible policy?
And the far left and the far right.
They just played it.
Again, remembering when we talk about far left and far right, think of a horseshoe. They do tend to join up in the middle, and they have ideological alignments in some points, and this was one of them. And so, France now is in gridlock, so much so that if you didn't see it, their government debt actually was worse than Greece for the first time in history. So France's ability to raise new capital, service their debt, is higher than Greece, of all things. That's my one that I'm watching closely. France is a very big global concern because we forget they're the 5th largest economy on the planet, and that matters. It does matter what happens to France, and so watch it closely.
Yeah, I put there also there's a part risk of an inflation spike, and that was probably off the back of this government spending idea, right? Problem, let me go and throw money at it. So I get ourselves into a debt cycle, and ultimately that's inflationary as part of that because productivity drops down, or it might just mean that the correction in terms of what is, say, the neutral cash rate won't necessarily play out as the ECB is thinking about.
Correct, and that was about the next point, is that unlike every other nation, the Eurozone is controlled by one central bank. So countries can't control their own scenario. So France can't go independently of the ECB and have the French National Bank move rates. Swiss can, because they've got the Swiss National Bank, but the French National Bank has been absorbed. It's now the ECB. So they cannot work their policy like the rest of the world can either.
Interesting times.
Interesting times.
And so that is a wrap for our December economic and RBA update. Around that hour mark, we always like to sort of stretch it out a little bit more. There was so much to talk about because obviously it's been 6 or so weeks since, and the biggest news
going on.
The biggest news in the world was obviously the US election. So we've seen the result there. We'll be back again in February to give a further update. And to your point, there'll be 2 Fed updates inside that as well. So it'll be interesting to see. And by then, we'll also have our December quarter, and we'll be keeping a hawkish eye on unemployment and where interest rates are going. And that bet still remains a little bit live, but not quite. I think I'm going to be paying out really soon. But Evan, thank you for joining us this year.
Thank you for having us. To all of you out there, Merry Christmas.
Merry Christmas.
Happy New Year to all of you. It's been fantastic 2024 in terms of doing these. Can't wait to do it again next year.
Yeah, and so please have a safe and enjoyable entry into 2025, and we'll see you on the other side with our economic and RBA updates. Thanks very much for watching, and remember, knowledge is empowering, but only if you act on it. Bye for now.